Hello, real estate brokers and potential home buyers. I am Grant Zabilski with Motto Mortgage HPLB, and this is your top 5 things to know about debt to income ratio when trying to get a mortgage. What is DTI? What is debt to income ratio? Well, it's an easy percentage that lenders use to see if the borrower is going to overextend themselves, if they have too much debt to afford the property that they're trying to get. So, how do they do this? Well, they're going to take 2 different kinds of calculations. One is called the Frontend DTI, and then the other is called the Backend DTI. Frontend DTI is going to take all of your housing expenses, so that's your mortgage, your property taxes, your homeowner's insurance, and your HOA dues, monthly HOA dues, and then it's going to divide it by your pre-tax income. That creates a percentage, and that's your front-end DTI. Easy peasy. So what's that back-end DTI? Well, the back-end DTI is everything that we just talked about with homeowner's expenses, plus we're also going to add on to those debts things like your minimum monthly credit card payments, your auto loan payments, your student loan payments, your personal loan payments, minimum required monthly debts like those. We add those up with your homeowner's expenses, and then we divide your pre-tax income, and then that creates a percentage. And lenders, say for like a conventional loan, we want those to be under 50%, right? So if you take all your minimum debts that you have to pay, divide it by your pre-tax income, if it says 0.5 or more, then it's probably that borrower's overextending themselves. So we want them to be lower. The lower, the better, and then they're able to, afford that house. Here's a little example. Let's say when we do all the calculations for the house that they want to buy, the mortgage plus the taxes plus the insurance plus the HOA assessment all adds up to $1,500 a month, okay? So $1,500 right there. Plus we have student loan debt, and that's $115 a month. And then we have 5 different credit cards. You add up all 5 of those minimum monthly payments, right? Just the minimums, add those all up. Now that's $310. Add that $310 on there. And then finally, we have a car loan. We have a pretty good car, but that loan requires us to pay $375 minimum each month for that car. So when we add up all of those payments, the mortgage, the student loan, the auto loan, the credit cards, all that combined is $2,300 a month, right? And so now we go, great, $2,300. What is our pre-tax income, our gross monthly income? Well, that's $6,000. So we take $2,300 divided by $6,000, and it gives us a decimal point. That decimal point is about 0.38, 0.38. So to make that a percentage, really easy, you just multiply that by 100, or just move the decimal point over 2 spaces, so that 0.38 turns into 38%. So that back-end DTI for this example is 38%. So if we're trying to get a conventional loan, that is right in range. We like that 38%. It's under 43, which is, if we know it's under 43%, it's typically a pretty healthy loan. Probably gonna get passed. Obviously we always look at the credit report and just see all the intricacies of what's going on, but we feel pretty safe about that one. What really is a good percentage when you're calculating DTI? Like, what percentage are they looking for? What's too high? What's gonna kick me out of the loan? What's gonna make sure that I get that house? So there are 3 ways that we're typically gonna get a residential property, and that's with either a VA loan, an FHA loan, or that conventional loan, right? So let's talk quickly VA. VA is, man, that is a good program, right? So if for our heroes, they really got something good. You don't need a down payment for that program, and you could have a back-end DTI ratio sometimes up to 60%. So that is huge. That is a lot of help, and that helps get a lot of people into homes. Now we have FHA. So that FHA loan that you've heard about, also really good. You can get a low 3.5% down payment. And for DTI, that back-end DTI, you can sometimes go up to 57%. That is also huge. There are caveats. We're always going to look at credit report and make sure that this is a solid person who repays their debts and everything, but sometimes you can go up to 57%, which is pretty huge. Now, conventional loan, this is somewhat of a wild card. The rules change all the time. But typically, at the very, very high end, we we don't see anything going over 50%. So that's definitely got to be under 50%. And depending on the buyer, it might be a little less depending on what's in that credit report. But, they do say, oh, we'd like to see it under 43. Well, of course they would like to see it under 43 because the lower it is, the better for the lender, the more chance that, hey, that buyer is going to pay back their loan. So the lower the better in all scenarios, and the lower the better for you as a potential home buyer, because you really you don't want to be stretching yourself thin. You want to be comfortable that I'm definitely going to be able to make my payments and repay and keep my credit score nice and high and build that equity in that home. How can I lower my debt to income ratio? Well, let's talk about 3 possible avenues. Avenue number 1, you can pay off your smallest debts. Yes. So that'll instantly lower your DTI. Say you got a $500 balance on a credit card or something like that. If you got that $500 to pay that off, then that $50 per month or $75 per month minimum that you got to pay on that credit card every month, that's going to instantly drop off. And then that makes your DTI instantly lower. So that is by far the greatest and easiest way to get a bump lowering your DTI. Number 2, we could raise our income. Well, how do we do that? We can get some side hustles. We could try to get another job. But here's the thing about that. If we're getting another hourly job or doing like side hustle, like self-employment kind of stuff, then that's going to take a couple years of work history for the lender to be able to count that income. So that's a looking in the future. I know I'm going to buy in 2 years. What do I do to lower my DTI to get myself in a good position? Unless you suddenly find this other job that is salaried, and then the lender gets to use that extra income instantly, which is pretty cool. And number 3, the third thing you could do is find somebody to co-sign. Say you're moving into the property with someone and they have a lower DTI than you. Hey, well, why not try to get them on the mortgage? Then your DTI is high, theirs is low, and then the lender's gonna average those, and it's gonna lower the DTI immediately. But they don't have to live with you. You could get a co-signer of someone else, say a parent or a grandparent or someone else that will co-sign the loan with you. If they have a lower DTI than you, that will instantly lower your DTI. Frequently asked questions. A few things that we have been asked about debt to income ratio are the following. 1, is all debt treated equally when trying to calculate debt to income ratio? Well, for all the debt that is always included, like those mortgage expenses, the housing expenses, plus your credit cards and your student loans and your personal loans and your auto loans and things like that, those are all treated the same. It's not a different weight on different things. It's just all added up and it's all in the ratio. But there are certain monthly expenses that nobody's gonna care about, like your utilities, like your Wi-Fi, like your phone, like your Comcast, like your entertainment costs, your groceries, your transportation costs, all these that you do spend money on monthly, but nobody's going to care about that. Those are all just outside of the realm. So those aren't included at all. Another question we have here is, how quickly can I improve my DTI? Well, if you saw in the last video, if you are paying off your debt, or if you have a co-signer come into the loan, you can instantly lower your DTI, just like that. Or if you are going long-term, if you're like doing a side hustle and picking up some extra income, then it could take a little while because it's going to take more time for the lender to be able to include that income, because they need usually about 2 years of solid income to have it included, unless, like I said in the last video, unless it's a new salaried position, then they can include that instantly. Should I apply for a home loan with a high DTI? Well, we would say it's up to you, but as a financial consultant, I would say you definitely always want to try to put yourself in the best financial position for the future. So it's weighing the pros and cons of, yes, you want to get into a house as soon as possible because it's almost like a forced savings plan. You're building equity and you're putting usually the sooner you're in the housing game, the better for how much equity you can build and putting yourself in a good financial position. That being said, if you're doing so in a way that is overextending yourself and you're struggling to make these payments because you have so many other debts that you can't juggle all this, you're overextended, then maybe it's not the best time. It's always best, if you can, to try to get your DTI as low as possible, so that you're in a comfortable position and you never feel like you cannot pay your mortgage, right? And then the last question we have here is, does my DTI influence my credit score? Good question. No, it does not influence your credit score. It is simply the calculation for the lender to see how overextended a borrower is, to see what the likelihood is of them paying that loan back. But it doesn't matter if it's high or low. You could have a super high DTI and an 800 credit score. Because if you're somebody who, even though that debt is really high, you are consistently paying all your bills and everything is clean on that credit report, boom, you got 800 credit score and you're sitting pretty. But the higher that DTI is, it's going to be harder for that lender to look at you and say, oh, maybe we shouldn't lend to this person, even though they have a really high credit score. Like if you have a 70% debt to income ratio, it doesn't matter if you have an 800 credit score. You're not going to get that property because it's just over the DTI in the guidelines. They have to have a lower DTI to be able to lend to you. Thank you so much for joining us in this 5-part video series of the top 5 things to know about debt to income ratio when trying to get a mortgage. We will see you in the next video series.